This split-screen chart tracks a balance over 30 years. The left climbs to $2 million. The right tracks the same path, but stalls at $1.5 million. As the icons filling the gap show, this massive loss comes entirely from fees and overlap. Most investors arrive at this deficit completely by accident. You pick up mutual funds because a coworker mentioned them, roll over an old 401k, buy whatever is in the news, and suddenly your money is scattered everywhere. We are going to replace that messy, accidental portfolio with something highly intentional, a 3-fund core. To do that, you need to understand what an index fund actually is. It is a vehicle designed purely to replicate a specific market, holding the exact same companies in the exact same proportions. The goal is to simply be the market, not to beat it. Because there is no human manager constantly buying and selling trying to pick winners, the management fees drop to essentially zero. The catch is the financial industry has spent the last 40 years building fake index funds. They slap the word index on the label for marketing purposes, but they quietly charge aggressive, actively managed fees. Organizing your scattered assets into a mathematically backed, strictly low-cost framework is the single most profitable financial decision you can make. This comparison matrix breaks down the broad market strategy. The input, a total U.S. market and total international fund. Outcome, you own thousands of global companies, capturing growth for fees around 0.04%. Trade-off, a flat market tracking line, forever forfeiting outperformance. While U.S. stocks have dominated recently, international markets trade at meaningfully lower valuations right now. Owning both means you never have to guess which region of the world leads the next decade. Down here in the matrix, we add the final component, the bond allocation, your portfolio's anchor. The outcome is stability. When stocks dive, bonds provide the cushion, keeping volatility in check. The trade-off is a capped growth ceiling. Bonds will never double your money. The exact percentage of bonds you need scales directly with your age and your personal panic threshold. A 20-year-old might hold 10%, while someone nearing retirement needs far more to sleep well at night. The 3-fund core guarantees your mathematically fair share of global market growth. It requires nearly zero maintenance, asking only for your behavioral discipline in return. The alternative to the core is falling for heavily marketed traps like actively managed growth funds and thematic ETFs. Let's add the trend-chasing trap to our matrix. These funds charge between 0.5% and 1.5% every year just to hold them. The historical outcome is severe. You have a 90% probability of underperforming a standard index. Thematic funds built around concepts like AI or the metaverse share a structural flaw. By the time a theme is hot enough for a fund, the easy gains have already been extracted. You are buying in at peak hype, right before the drop. Then there is the false diversification trap. This happens when you hold 15 to 20 different mutual funds across multiple accounts, assuming you are well protected. This Venn diagram exposes fund overlap. Owning many different funds usually means buying the exact same mega-cap tech companies wrapped in different packaging. Shifting to plot effort against diversification, you see the problem: intense concentration risk while burning high mental effort. Adding more funds to a portfolio does not increase your safety. It only multiplies your complexity, your hidden fees, and your concentration risk. Once you choose the right funds, you have to execute an asset location strategy. Where you hold a fund impacts your total return just as much as what the fund actually is. Look at these 3 tax buckets. Tax-deferred accounts, like traditional 401ks, are optimal for bond funds, shielding interest payments. High-growth stock funds belong exclusively in the tax-free Roth bucket. Finally, tax-efficient total market index funds are perfectly suited for standard taxable brokerage accounts. Deliberately placing the right funds into the right tax buckets can add tens of thousands of extra dollars to your lifetime balance, and it does not require taking on a single ounce of additional market risk. It is time to translate this into an actionable blueprint. Your next step is to log into your accounts and audit your current holdings. This decision tree flowchart outlines the audit. First, is the expense ratio greater than 0.15%? Next, is the fund built on a trendy narrative, and do top holdings overlap the total market? If yes, follow the red arrows to consolidation. If you are short on time, the execution is straightforward. Establish a baseline split at 60% US, 25% international, and 15% bonds. Automate your monthly contributions and ignore the financial news. If you have an overly complicated portfolio, stop buying new products immediately and aggressively prune your overlap down to the core 3 branches. The ultimate challenge of a 3-fund core is behavioral. You have to fight the sheer boredom of holding a perfectly optimized, static portfolio for decades. Heavy marketing is a warning sign. Scrutinize any fund pitched on TV or by influencers, because massive marketing budgets are directly funded by extracting wealth from retail investors. True generational wealth is built quietly, by owning the entire market. The financial industry relies on the loud extraction of fees from people searching for a shortcut. Note that this framework is for educational purposes only, and you should always do your own research before investing.